right, we are live. Matt, the mortgage guy, with another rendition of YouTube Live. This week, I've got Bill Angove. Hopefully, I pronounced that right, my man. 1031 exchange expert, senior VP at Asset Preservation, and somebody who I've met and I know runs in similar circles here in Sacramento, but can do 1031 nationwide, right?
Absolutely.
I'm excited to just jump straight into the conversation, talk about 1031s as a mortgage broker who's dealing with clients who are doing 1031 exchanges all the time. I realized that as much as I'm a part of these and I'm helping people buy forward, truth be told, I don't know all the intricacies and all the, what a boot means and all that stuff. So I'm excited just to have an open conversation, ask some questions. If you're watching this live, fire away with any questions you have. If you're watching it on replay, test me after this thing has gone live, and it will live on YouTube as a replay, and see if I retain the information I learned today. I've even got my Google Notes up, Bill, so I'm going to take some notes here. Maybe let's just start off, introduce yourself, who you are, and let's jump into it.
Great. First of all, Matt, thank you very much for having me on your show today, and I look forward to the conversation. Everyone, my name is Bill Angove, and I am a Vice President with Asset Preservation. We are a national qualified intermediary for 1031 exchanges. Our company's been in business for over 33 years, and I've been doing this for 26 years, and I'm the state manager for our company also. But as you pointed out, exchanges are nationwide. Although our national headquarters is here in the Sacramento region, we handle exchanges across the country for anybody selling and buying investment real estate.
Cool. All right. Well, let's start with exactly what is a 1031 exchange. So I'm sure there's some people listening that's like, I've heard about it, and I want to not pay taxes. That sounds like a good thing. And I love real estate, and maybe I can exchange some real estate for other. What would be your 30-second kind of what is a 1031 exchange?
Sure. Anytime that someone's selling a piece of investment property, whether it be a rental house, office, duplex, triplex, you name it, they can sell, defer their taxes under section code 1031 of the Internal Revenue Code, defer those taxes and buy new investment property anywhere in the United States. So our role in the transaction is, prior to the close of escrow of their old property, they would engage us to prepare the necessary exchange documents, and we hold their proceeds between their sale and their purchase in the transaction. So tax deferral is the number one benefit of an exchange.
Awesome.
Not tax-free.
You're right. It's an awesome benefit, because those that maybe don't know, you buy an investment property, you hold on to it for a decade, and for whatever reason, like, I don't like this area, or I'm looking to get to some different type of asset. You sell that without a 1031 exchange. It's just capital gains, right?
Yep, and that's a taxable event.
Right. Yeah. I was explaining that to my wife the other day, and my wife's great because I get to bounce stuff off her as, an average, consumer who's not in it every day. And she's like, what do you mean if we sold that property, we'd pay, 25% of the gain to the government? That doesn't make any sense. We paid tax 4 different times on the same asset, but, with a 1031, you can avoid that. And so I'd love to start this off. You educating me a little bit and talking and walking through what might well be a real life scenario. I've got real estate investment assets, my wife and I, and over time, goals change. And I know this through working with a bunch of clients. It might be that, like, that fourplex served us, but we've got 300,000 or 400,000 in equity in that. Maybe we'll sell it and we'll buy something, closer to home, a different type of investment asset that we think will perform better. One thing I do know, correct me if I'm wrong, a lot of misconception around it is, like, you sell a single family, you've got to buy a single family. What you said to start, Bill, is you can sell anything that's considered an investment and buy a new investment, right?
That's correct. The biggest misunderstood thing about 1031 exchange is the term like kind. Many people call me, after 26 years of doing this, and they do some Google search on exchanges and find some old material that says, oh, if you sell a rental house, you have to buy another rental house. And that's not the case. Like for like means investment for investment. So I could sell 3 rental houses and buy an office building. As a matter of fact, we're seeing quite a bit of consolidation going on, especially with the boomers. They're tired of the T's: tenants, toilets, termites, trash, and taxes. So they're tired of all those management headaches and fixing toilets, etc. So they'll sell 3 properties in exchange, maybe out of California to another state, and buy a single tenant, triple net CVS or Dollar Tree or something along those lines. So they don't have to worry about management of those properties anymore.
Right. Yeah. Know what I know about real estate. Certain investments are active management and a lot of work, and others like those triple net leases where you've got, Starbucks or CVS is relatively, easy to manage and probably something that a lot of people, like you said, you're seeing it. So the proof is in the pudding, right? People are saying,
right.
I don't want to manage a 14 unit in North Sacramento anymore. It's a lot of tenant turnover, even though I've got property managers. I'm dealing with something every single week. Maybe I can sell that, take those proceeds and take that equity and go deploy it elsewhere. So let's get into my specific scenario. I've got a couple fourplexes, and one of them specifically I'm thinking about, and I'm sure this is what goes on in investors' heads, right? There's a lot of turnover in 1 bedroom, 1 bath, units inside of a fourplex. It's more work and more headache than maybe I want for the next decade or two. If real life scenario, I paid $270,000 for this when I bought it.
Mm-hmm.
It's probably worth $500,000. If I sell that, what does it look like? Do I have to, take all those proceeds? Let's say net agent fees and the other stuff. I've got 200,000 in, quote unquote gain. What does that look like purchasing forward, regardless of what type of asset is?
Right. There's 2 equations that we look at. Number one, the capital gain calculation, which is a lot what you're talking about. I paid X for it. I'm selling for Y. I've got X amount of gain. So that's what you defer in exchange, but that's not the number you would work with in buying your replacement property when you do an exchange. On our website, matter of fact, if people want to look up after we're done, on our website, we have a template called the exchange equation, or the other one's called requirements for full deferral if your clients want to look that up, and that explains that. But really, we're working off the sales price. So one way to say it is go buy a new property of equal or greater in value, and that's the very general definition. So if you sell for 500, go buy another property for 500 or greater if you want full deferral. Now, I want to preface, this is not the IRS regulations. This is, if you don't want to pay any taxes, do 2 things. Number one, reinvest all of your exchange proceeds. Number 2, acquire a new property that has the same or greater loan. So if do you have an outstanding debt on that property at all?
Yeah, I think I owe $195.
All right, so we take our sales price of 500, back out your closing costs and commissions off the top. That's your escrow and title fees and commissions. That gets you to your net sales price, right? So that's what you want to go buy for or greater. That net sales price is made up of your outstanding loan balance and your equity. So spend all of your cash equity, take on equal or greater debt. People go, oh, I just want to reinvest my profit, my gain. That's not the case in an exchange. Or they'll say, well, I borrowed $100,000 from grandma and I want to pay her back. That was my basis, so I want to pull that back out. That's not the case. Your clients need to understand that any money they touch, fix up to pay themselves back, fix up costs, basis, you name it, it's called boot. So any money they touch is going to be taxable. If there's leftover money at the end of the day, if you don't go buy a property for $500,000, you only buy something for $3,000, that difference is going to be taxable based upon your capital gain.
Okay. So this is good, and I love that it's a real life scenario, and I could put some real numbers around it. So we'll call all the fees and whatnot $50,000. So like $450 minus the $270 I bought it for, which maybe isn't even the equation here, right? I just got to buy something that costs $450 or more. I'm not going to go take that and buy something cash for $180 and be done with it, because then I'll be taxable. So I'm going to buy something that's at least $450,000
or more.
I'm going to have at least $195,000 in debt on the replacement property, because I've got $195 in current debt. And so I avoid or defer taxes in that case. What if I net $450 and I say, you know what, I want to have $50,000 for myself, whether that's pay off debt or, grandma or whatever the case may be, am I paying taxes on just that and the rest of
That's
it's
correct.
covered?
Yep.
Okay.
And so when you have the property in escrow, you would notify our exchange team and the escrow officer, you want $50,000 at the close of your old property. So you're going to pay taxes on that. Also keep in mind is California has a withholding law. So they'll take the escrow officer closing at the title company is required by the state of California to withhold 3 1/3 of that $50,000 as a prepayment for your California taxes.
Okay. Is that regardless of if I'm moving it all forward and I'm exchanging?
If you move everything forward, you're totally deferring the taxes, both state and federal.
Okay.
But any money you touch or in the beginning or any money that's left over is called boot, and you'll pay taxes on that.
Okay. And they'll just take that 3 1/3 from just the boot.
Correct.
Okay. Okay. All right.
If you are doing a straight sale, the escrow officer would have to withhold 3 1/3 of the total sales price of the $500,000 as a payment for California.
Okay. Yeah. So if there's no 1031 involved, I'm just selling it. They're going to withhold that. And California's going to make sure they get their slice of the pie.
That's right.
All right. All right. Cool. All-nighter hider. We got a buddy of mine joining. Fire away any and all questions on 1031. I heard as we were talking off air that Bill's going to be retiring soon. So this is the last chance we're going to get to ask the man, the myth, these questions. I know you got somebody taking your place so they can still, work with asset preservation and get great service over there. Who's going to be replacing you over there, Bill?
Sure. I hired someone out of the real estate industry. Her name is Michelle Diodati. And she actually, her first day is tomorrow, and she'll be going through training for the next week or so, plus ongoing training. I mean, I've been doing this for 26 years. You're always constantly learning something new and get scenarios, et cetera. So she'll be working with our VP out of Colorado and our president, Javier Van de Steeg, for the time being. So we probably don't need her taking calls right from the get-go, but they can call the local number, which is 916-791-5991. And talk to some very experienced people to get answers. Awesome. I'm not going anywhere. I'm just basically retiring.
Okay. Sounds good. Yeah. You've put in a good time, and it sounds like, when you talk about 1031s, things constantly evolving. Sounds like the mortgage industry to me, to where, I'm going to learn something new next week. I don't know what it is yet, but I'm definitely going to learn it. Right. I'd love to hear, since you've got all these decades of experience and so you're able to see it, it feels to me like there's a lot of action going on in that 1031 space. I think I've got a 2-part question. What are you seeing currently? What investors are doing? Because I think that might give other investors some ideas. Like, oh, I didn't realize I can do that. Maybe I should, sell a couple of these and buy this. And then I'll save my follow-up question. But what are you seeing out there?
What's funny is our 2 busiest years were 2005 was our #1 year since our inception. 2021 was our 2nd busiest year since our inception. And so 2021, 2022, we were really, really busy, even though COVID happened. But more people own rental houses, 1 to 10 units than people own $50 million office buildings. So when the interest rates kicked up on you guys on the lending world and things slowed down, it also slowed down in our 1 to 10 unit exchanges. And that's been that way up until about the last month. And we're starting to see, and historically, the spring, I call it the spring thaw, but historically, we start seeing the phones pick up in the spring, and that's what we're seeing right now. People are starting to list properties. Deals are starting to happen. The phones are ringing a lot more in anticipation of doing a future exchange. I heard at the Placer County Association, a realtors meeting this morning, that inventory is still only about 2 months. And so that's making it hard because prices keep going up, but inventory keeps shrinking. So although that's happening, the other thing, the trend that we're seeing and have been seeing for 3 or 4 years is exchanging out of California. Not only are people moving to Tennessee, the Carolinas, Texas, Florida, you name it, we're seeing people exchanging out of California, which you can do, no problem, because this is federal tax law, but California does have a clawback law. So let's say you took your $500,000 property and exchanged to Nevada, which is a 0 tax state. Great. But the problem is California says you have to continue to file a California informational tax return while you own that property outside of California, I almost said the United States, outside of California. So eventually, if you sell that property in Nevada, California says, show me the money on the tax from that exchange. So the other thing that along those lines is people are exchanging to those states I mentioned, but they're also moving there. So what some people are doing is moving, but also moving the rentals along with them, and maybe putting a family member in there as a tenant, or buying a property that they're going to keep as a rental and then move into it a couple years down the road. So those are the big trends that we're seeing right now.
Okay, and that's perfectly legal, because I know in 1031s, it's got to be investment property to investment property. And
Right.
so, if I took 3 single families and I said, you know what, I'm going to buy a vacation rental in Hawaii and rent it out. If I move there in 3 years, no harm, no foul?
Correct. Well, if you ask the IRS, they would say you should never have the intent to move into the property. Okay. So that being said, the magic question is, how long do I need to hold that property before I do my next exchange or move into it? Conservatively, a lot of tax advisors say hold that property for at least 2 years as a rental. You can buy land. Land can be held for investment, but if you're buying a single family property, it should probably be a rental for that period of time. So you're reporting 2 years of income, writing off the depreciation, all that kind of the mortgage interest, etc. And then what happens down the road, who knows? But that's what we're seeing. Yeah.
Right. Yeah. Go ahead.
I was going to say we're doing a lot of exchanges into and out of vacation home markets, Hawaii, Scottsdale, Tahoe, marketplaces like that, where people are setting themselves up for a future retirement. So they'll just follow the seasons, move into their vacation homes after that 2 or 3 or 4 years, whatever it is, when they sell their primary residence in California, and just follow the season, so to speak.
Right. Yeah. I mean, it sounds like a good deal for me. You've seen all this appreciation in California. You've got these assets that, hundreds of thousands, and for some people, 7 figures in equity. You go, use that to buy something that's going to be a rental for the foreseeable future. And if the IRS is listening, that's the intent. And life changes happen. So 5 years from now, we might move the family into that. What I've seen, and me being on the lending side, I'm talking to real estate investors all the time. They've you come up with terms for everything, and it's portfolio optimization is the term I've been hearing a lot of, and it makes sense to me, right? Because you look at your real estate assets and you say, I've got this property, which when I first bought it, or when I had $100,000 in equity in that deal, and it was spitting off $12,000 a year in profit, that was great. It was 12%, return on equity. Years have gone by. Maybe you've seen some rent increases. Maybe there's been, some costs, and now it's kicking off $15,000 per year. But if you now have $400,000 in equity, that cash on equity return is now 15 divided by 4, 3.75%. See, I'm a math guy. I've got coffee in me. I'm doing all right, Bill. And so people are saying, hey, I can do better than that with a different, asset. And so that's generally, one of the reasons for 1031, right?
Absolutely. And along the lines of, I get the question all the time is, I'm real estate rich and I'm cash poor. They own these properties free and clear after they've owned them for so long time, and that's going along the lines of rate of return on your investment. That's not the best thing to be, because you can leverage, other people's money, so to speak, to go buy a bigger and better property, take that $1 million and use it as a 25% down payment or a 75% LTV. Look how much more property they can leverage into, and they can buy more than one property. You can sell 3 and buy 1, and sell 1 and buy 20 if you want to.
Okay.
So we see that. But when I talk to these people about owning properties free and clear, they say, how can I get out of my property tax-free? I say, well, you have to die. They don't like that option right about now. But one of the things I do tell them to do is take that $1 million of equity, go buy a $1 million property, and then call Matt and refinance that property and put an equity line against it, because the interest rate's going to be lower than pulling money out through taxes, right? So if I pull out $100,000, I'm going to take about a third of that and kiss it goodbye in taxes, versus I move all my $1 million equity into my new property, and I call Matt and say, Matt, can we refi or do an equity line for $100,000? You can say yes. And that's a lot cheaper than paying 30% combined taxes on that 100 grand.
Yeah, that's a great point too. When people are, barking at me about 7.5% on their investment property, I'm a lot less expensive than the IRS when it
Exactly.
comes
That's a good way to put it. Yeah.
money, right? So, yeah, thanks for that plug. If anyone wants to connect with us and get a mortgage, we'll happily help you out with that. Greatmortgagebroker.com. Just quick plug for my own stuff. So, I want to get into the nitty gritty because I think I know, but then things change. When it comes to this, you mentioned lack of inventory, which I'm sure is some people's fear. Is I know I want to do a 1031. This asset isn't performing, or it's not in a neighborhood or state or place I like. Remind me of the rules for how many days. I tell you, hey, listen, I want to buy something different. I'm going to sell this property. I know, and this is another piece of advice for everybody out there. You can't touch the money. The money's got to go straight to the 1031 exchange, and then it's got to go straight into the purchase of the next property. Don't ever let your hands touch it, because then the IRS gets their hands on it. What are the rules around days to identify and all that stuff?
Yeah, so let's go through, in your words, of practical application. So you'd put your property in the market, find a buyer, open escrow with your favorite title company, just like selling a primary residence. Where we get engaged is typically about a week to 2 weeks before close of escrow. As we talked about before, if someone calls us after the fact, that's still a taxable event. So we're going to talk to the client and say, get your name, address, phone number, title company that's handling the transaction. We request the preliminary title report and the purchase contract to be sent over to us. We prepare the necessary exchange documents for your client to sign, typically electronically. So when they close, as you mentioned, the proceeds are sent to our company to hold on behalf of the taxpayer during the transaction. From that closing date, there's two timelines that begin. First, the total timeline they have to close on the replacement property, which is 180 days from the close of their old property. The other timeline that's kind of more important is the identification period. They're given 45 days to identify in writing unambiguously the potential property or properties that they're looking at buying. So as part of our service, we provide your clients an identification letter when they close their old property. They fill that out with the addresses of the properties they're considering buying, and they'll send that list to us before midnight of the 45th day of the exchange. So one of the options is they can identify 3 properties. It doesn't matter the price order of those properties. They can buy one or all 3 of those properties if they so choose. Excuse me. The important thing to note is this, is people ask, can I change my list? And the answer is yes. You can revoke your old list and change it, but only during that 45-day identification period, not after. So if they get out to day 75 of their exchange and they can't or don't want to buy any one of those 3 properties, they cannot change their list, and they will have to wait until the 180-day exchange period is over to get their proceeds back, and they're going to pay taxes like it's a straight sale. The other thing that they should be aware of is that if they identify properties and they get out to that 180-day period and they don't want to buy any of those properties, again, they'll have to wait until day 180 is over to get their proceeds. That wasn't my train of thought. My train of thought was this. So I know I'm going to close escrow on my fourplex on April 1st. Can I be out there looking and even making offers on my replacement property before I close my old property? And the answer is yes, you can. You're not required to have the replacement property in escrow to identify it. All we need is an address. Typically, it has to be unambiguously described. So if you and I were buying a property together, Matt, you would identify 50% of 123 B Street, and I would identify 50% of 123 B Street, right? So they can go out and make offers, but the thing that they want to consider, and this is the downside to making offers before you close your old property, is you'd probably make your offer on the replacement property contingent upon close of escrow of your old property first. Because if something falls through on your old property and you're in escrow to buy the new one, you're going to at least lose your deposit.
Right. Okay. So, there's some caveats to this. There's some complexity to it where I'm sure, some people hear that like, oh my gosh, it's tough. Well, it's a great benefit to defer these taxes. And so, it's something that you got to do. 1 to 3 properties is the rule that you've got to close on at least one of the 3 you identified. So real life example, I know I'm going to sell the fourplex. and I've got to buy something that's at least $450,000, and I've got at least $195,000 in debt on it. Is there any rules around those three I identify? Like if they're all individually higher than 450, or maybe I've identified two that are 225 each and one of them's 550. That doesn't necessarily matter.
At the end of the day, so long as you've bought $450 worth of property or properties combined, great. That's fine.
But I can't identify more than three if I'm like, hey, I'm looking at these two that would combine to be 450. I'm looking at, maybe I'll buy these three. Three is my max.
Well, I mentioned there was options, and I mentioned the 3 property rule is the first option. The second option is the 200% rule. And that says if you identify 4 or more properties, the value of all of them combined cannot be more than twice the value of the property you're selling. So let's say you list 5 or 6 potential properties. The value of all of them combined in your circumstance cannot be more than $900,000. All right.
Okay. So I got to identify 6 that are 150 grand each. I just know that I've got to buy 3 of those to defer everything.
3, or you can buy the whole list so long as all of them together don't exceed $900,000. The third and final option they give you is the 95% rule, and it says if you do identify more than 3 and their values altogether exceed twice the value of the property you're selling, the 95% rule says you must acquire 95% of that list. So if you identify 5 properties worth $2 million altogether, you have to buy them all under that option.
And if I bought 4 of the 5, about 1.6 million in real estate, what's the tax implications of that?
Well, unfortunately, if you don't fit into any one of those options, your exchange could potentially fail at that point, because it's either the 3 property, 200%, or 95%. So if you've exceeded the 3 property rule, you've exceeded the 200% rule, and you can't acquire 95%, your exchange fails.
Okay. All right. Well, that's scary. A follow-up question I have too is there's been talks around, potential changes to this 1031. And I know real estate investors, are up in arms when there's legislation being proposed that it might go away or it might change. What's the latest on that, and what's your predictions for the future of 1031 exchanges?
So each year when President Biden has come out with his budget or a proposed budget, each year the staff have built in there to place a limit on the amount of gain that someone could take out in any given year. For example, if you're single, you can do an exchange, but you're only going to be protecting $500,000 a gain. If you're married filing jointly, it would be $1 million. Each of those 3 years that has been written out before it got to the final signing, so to speak. We have a very strong lobby in the exchange business. The real estate industry has a very strong lobby with NAR, et cetera. Anybody that touches a deal has a strong lobby against these rules, whether it be an escrow and title, lending like yourself, CPAs, attorneys, you name it. Everybody lobbies that, and typically it's been taken out of the proposed budget. So it's in there now. I saw it come in the other day. We don't anticipate it will make it through, but if it does go through, mom and pops won't be hurt. It's going to be the big dogs that the $10 million, the 20, 30, $50 million, where they've got a huge amount of gain. They're not going to be incentivized to sell their property and do an exchange because they'll only be able to protect 500 or $1 million of the gain.
Okay. So yeah, even if something changes, it won't necessarily affect me, but it'll affect some bigger dogs. So I can at least sleep easy. And it's worth mentioning too, for people that don't know, on your primary residence, this is totally separate from the 1031, but you do have an exclusion where if you're single, you can, have, tax exemption from 250,000 in gains on your primary residence, 500,000 in exemption on, for a married couple. So you buy a house, you live in it. Is that rule still 2 of 5 years?
Correct. Yeah. 2 out of 5 years. So what we're seeing, yeah, it's any 2 years out of a 5-year window. But along and tying that to 1031 is we're seeing people in the Bay Area, have a huge amount of gain on their primary residence. They cannot do an exchange, but what they could do is they can rent that property out for up to 3 years and do a combination of an exchange and the primary residence exclusion, right? Because we talked about that holding period, 1 to 2 year period. So let's say they run it out for 2 years, they can do a partial primary residence exclusion and do a partial exchange on their game.
That's pretty cool. Yeah. So it's like it fits both buckets. Like I haven't lived there the last couple of years. It's been an investment property, but I lived there, 3 of the last 5 because of the 3 before that. So I can, married couple exclude 500,000 with that exemption. And then you can do the 1031 exchange and defer the rest essentially. Right.
Right. Man. We have another piece on our website in our exchange library is called 1031 in primary residence, and has about 5 different scenarios. People moving into the rentals or out of the rentals, or you name it.
Okay, cool. Yeah, when this video lives on YouTube for the rest of eternity, the scrolling thing that which people wouldn't be able to click on, I'm going to put that so they can click straight on and go to asset preservation and find all the information, which is valuable stuff. I appreciate it. I got my buddy putting in all kinds of crazy stuff in the comments. I
was just seeing that too.
I have no idea what any of this stuff means. Is this stuff Japanese to you too, Bill, or is this stuff read English? Where?
I'm just trying to look at it. I can't see. Let's see here. Where is the U.S. located under Uniform Code 9-307? Location in the United States, located in the District of Columbia. No idea where he's going with that.
Yeah, I think he's trying to make a case to the IRS. You probably have to got to read the codes, statutes, regulations, etc. No evidence that I am legally defined person as recorded. All right, well that's good reading.
But we're just talking about Section Code 1031 of the Internal Revenue Code today.
Yeah, I was
just leave it at that.
It's tax code, baby. All right, all-nighter rider.
Easy to copy and paste tax code, I guess.
Yeah, it's far above my pay grade for sure, but cool. Anything else you want to add before we jump off? I appreciate your time, and I certainly learned something. I got some good notes here: the 95% rule, the 200% rule, 180 days from close to close, 45 days to identify. I feel smarter than 30 minutes ago when we started.
The only thing I would mention, there's another type of an exchange called a reverse exchange. And for your clients that have the ability to buy first, it's a great tool, because the biggest complaint people have about exchanges is the 45-day identification period. So if you think about, if you've got those angel clients that want to or need to and have the ability to buy the replacement property first, you cannot exchange into a property you already own. So per the IRS, it's a revenue procedure all-nighter, by the way, revenue procedure 2000-20, 2000-21. It allows them to, through a qualified intermediary, I'm sorry, it's 2000-37, if you want to look it up. It allows them, using a qualified intermediary, to buy the replacement property. So we form an LLC. That LLC, with funds from the taxpayer, closes on the replacement property. They then have 180 days to then close their old property and exchange forward into the one that we're holding for them. So
reverse exchange, that's cool.
Not reverse mortgage, reverse exchange. Typically, they're either paying all cash out of their piggy bank to buy the property and then refinance it down the road, or if there's a lender, and this might be your area here, Matt, is if there's a lender that understands we're going to be the buyer/borrower initially, the taxpayer can guarantee the loan, but our LLC is the buyer/borrower. So in the loan docs, it's going to show our LLC is the buyer/borrower. And then ultimately, when they exchange out of the old one, a new one, you write them a new 30-year or 10-year loan, depending on what type of loan it is. But that's where we run into the problem with the underwriting folks, trying to figure out who's going to guarantee my loan initially, and it's not going to be asset preservation.
Right. Yeah. My guess is it's probably got to be a non-QM loan. That might be something that Fannie and Freddie would steer away from. But
exactly,
closing it in LLC with a non-QM loan could probably be the play there. All right. Final question. I'm gonna let you go, Bill. What is the coolest 1031 exchange you've been a part of? Whether it's because it was the biggest or it was something that you hadn't seen before. I'm sure in 30 years you've seen some cool stuff. You don't have to give details, but just what was the coolest one you've been a part of?
I'm going to mention two. You used to be able to do personal property exchanges. So people used to be able to do exchanges on farm equipment, airplanes, cars, trucks, so long as they were held for investment. Who it really helped is people like farmers that do an exchange on the real estate, but also on their John Deere tractors and all that. In 2018, that went away. But one of the exchanges we did a number of years ago was on a collectible car. It was a 1965 convertible Ferrari. Any guesses what it was worth?
1965. I'm not a car buff, but a 65 convertible Ferrari sounds pretty cool.
$700,000.
Wow.
So that gentleman had to do exactly like kind. He had to buy more collectible cars. So he bought a DeLorean, another Ferrari that's a collectible car. DeLorean, Ferrari, and he wanted to buy a GMC truck, which does not qualify for his personal use. So he bought more, and then you can sell gold coins and buy gold coins. So that's one example. And then I think it's been about a couple of years ago. Well, we just did a $100 million deal for a rancher out of Maxwell. So that's a very large deal that we have in our hats. And we've done $1 billion exchanges also, where it was a collective of properties throughout the United States. But the one we did that I remember involved a family that, let's say, is in the wine business. And it was $85 million office building in San Francisco. And we had probably 8 or 9 different family members on title and entities we had to work with. So we had to create 8 or 9 different exchange documents for each family member. Some of them own properties in trust, some of them own part of the property in LLC. So you had all these different entities on title, and they all were going their separate ways. So it was an interesting deal. Some of them finished their exchanges, some decided they're just going to cash out.
Wow. Yeah, that's cool, man. Yeah. Little old me. I'm just talking about little old fourplex in Marysville, California. But yeah, that's the cool part about it, I think, is that for the average investor, and for the average person, you can utilize the same tax codes and tax benefits and deferment that the big boys use. So thanks again for joining me, Bill. I really appreciate your time, man.
My pleasure. Thanks for having me.
Enjoy fishing or golfing or whatever you do in retirement, and I'm sure people that find asset preservation and your colleagues there will be in good hands.
Thank you. Appreciate it.
Thanks, Bill.